for own stocks for the long run. If you need your money back within a few months, it's foolish to own stocks. But if you won't need your cash for another 10 or 20 years, it's foolish not to own stocks.
I think this is a very simple lesson. I mean, and we all know it, right? If you put your money in the stock market, and the market go down, and suddenly if you need to spend it, you got a problem. But if you have a reasonable time horizon, why would you own anything else? You know, 30 years from now, you'll look back and say, why didn't I have more in stocks? Sure, you might not feel that tonight if the market is down on the day, but 30 years from now, you will look back and say, oh boy, if only I'd had a higher percentage of my portfolio in stocks. Think about how much better I'd be off today. And it's simple. You just need to look up beyond the valleys and see the peaks in the distance. It's an emotional game in the end.
And Peter, you often talk about the analogy of the casino and how really it's very different if you're an investor, what the odds are. It's the longer your holding period, really, the more you should expect in terms of a positive outcome and a big return.
Yeah, as an investor, you're the house on any given hand in any given year. Anything can happen. Like today, the market, the odds it's going to be up or down is about 50-50. You go over a year, the odds are going to be positive 75%. And as your chart shows, you start to go out 10, 20 longer, you go to 100% really quick. You're the house. In Vegas, one hand could go either way. Play a bunch of hands, the house is going to win. You play for a decade, the house is 100% going to win, right? And so the longer you play, the more you win. It's the opposite of how most people think it works.
Yeah, and I think, Jonathan, I think you've written about this because people will often say, well, what if there's another Great Depression? I say, well, I'm glad you brought that up because even during the 30-year period, let's say you had bought at the peak in 1929, 30 years later, you actually did okay as a stock market investor, didn't you?
Absolutely, you did fine. Particularly, once you figure in the fact that it was a period of deflation, so that you know, normally we're worried about inflation, but in real terms, the S&P 500 actually recovered very quickly from the 1929 crash. Also, and this is no criticism of your chart, Charlie. What we're talking here with this chart is you make a one-time investment and see where you stand. 1, 3, 5, 10, 20 years later. But
Lump
most of
sum,
us
yeah.
are investing over time. We're buying at all kinds of different prices. And that means that your odds of making money over these different time periods is substantially greater.
Great point. Yeah. If you're investing every 2 weeks into your 401k or IRA, you should almost be, and Peter and I have talked about it, you're rooting for the market to go down in the short run. You want to be buying more. It's only when you're in the withdrawal stage that you want that higher price. And just to give people an idea of why you should own stocks for the long run versus just treasury bills, which there's some certainty there in terms of it's never going to go down in value. It's only going to go up. You don't know what the interest rate's going to be. But over a 30-year period, on average, 100,000 in treasury bills bring up to around 392,000, 100,000 in the stock market, on average 2.5 million.